Imagine seeing footprints in the snow. You may not know exactly who left them, but you know someone was there. Volume works the same way. Volume leaves clues. It reveals participation. It reveals conviction. And sometimes it reveals the actions of large institutions. Most beginners focus only on price. Professional traders study both price and volume. Because price tells you what happened, volume helps explain why. Today, you're going to learn one of the most important concepts in technical analysis: volume, the hidden force behind many of the market's biggest moves. Let's begin. Part 1. What is volume? Volume is simply the number of shares traded during a specific period. If 1 million shares are traded today, today's volume is 1 million. If 10 million shares are traded tomorrow, tomorrow's volume is 10 million. That's it. Volume measures activity, participation, interest. Think of a stadium. A football game with 50,000 fans feels different than one with 500 fans. The same principle applies to markets. Large volume often signals strong interest. Small volume often signals weak interest. Volume helps us understand how much conviction exists behind a price movement. Part 2. Why volume matters. Let's imagine two stocks. Stock A rises 10%, stock B rises 10%. At first glance, they appear identical, but then you examine the volume. Stock A rises on massive volume. Stock B rises on very low volume. Which move is more convincing? Most professionals would pay closer attention to stock A. Why? Because more participants supported the move. Volume acts like a voting system. The greater the participation, the stronger the message. Price movement without volume can be misleading. Price movement supported by volume often carries more significance. Part 3. The relationship between price and volume. This relationship is one of the foundations of technical analysis. When price rises and volume rises, the trend is often considered healthier. Buyers appear committed. Participation increases. Momentum builds. Price rises, but volume falls. This doesn't automatically mean trouble, but it can suggest fewer participants are supporting the move. Professional traders pay attention to these differences. They ask, is the market moving with conviction, or is enthusiasm fading? Volume helps answer that question. Part 4. Breakouts and volume. Imagine a stock has struggled to move above a certain price for months. Then one day it breaks through resistance. Many beginners immediately become excited, but professionals ask another question. What happened to volume? If volume explodes higher during the breakout, confidence often increases. Why? Because more market participants are supporting the move. The breakout has energy behind it. Now imagine the same breakout occurs on weak volume. The move may still succeed, but the evidence is less convincing. This is why volume is often called the fuel behind price movement. Part 5. Volume spikes. The market is telling you something. Sometimes volume suddenly explodes. A stock that normally trades 1 million shares suddenly trades 10 million. This is called a volume spike. Volume spikes often occur because something important happened. A major earnings report, a new product announcement, an acquisition, a regulatory decision, or significant institutional activity. Volume spikes do not tell us exactly what will happen next, but they tell us something important. Attention has arrived, and attention moves markets. Part 6. The footprints of institutions. Large institutions manage enormous amounts of money. They cannot easily buy millions of shares without affecting price. As a result, their activity often leaves clues. One of those clues is volume. Imagine a stock suddenly experiences unusually high volume for several days. Professionals become interested. They ask, who is participating? Why is activity increasing? What changed? Volume cannot reveal every answer, but it can reveal that something important may be happening beneath the surface. This is why experienced traders monitor volume so closely. Many beginners completely ignore volume. They focus only on candles, only on indicators, only on predictions. But volume provides context. Imagine watching a movie with no sound. You can still understand some of the story, but you miss important information. Charts without volume are similar. Price tells part of the story. Volume helps complete the picture. Instead, they ask, what evidence supports this move? Volume is one piece of that evidence. Trend is another. Support and resistance. Instead, they ask, what evidence supports this move? Volume is one piece of that evidence. Trend is another. Support and resistance. Market structure, risk management. Successful investing is not about certainty. It is about building probabilities, and volume is one of the most valuable clues available. Part 9. Advanced volume analysis. To truly master the market, we must look deeper into the relationship between the spread of the candle and its volume. Spread refers to the price range between the high and the low of a single candle. When we see a wide spread on high volume, it confirms massive effort resulting in massive movement. But what happens when we see a tiny spread on massive volume? This is an anomaly. It suggests that despite huge effort, price is being met with equal and opposite pressure. In technical analysis, this is the law of effort versus result. If the effort is high, we expect a high result. If the result is small, something is hidden beneath the surface. Part 10. Accumulation and distribution. Smart money doesn't buy all at once. They accumulate their positions slowly, often over weeks or months. During accumulation, price stays in a range, but volume tells a different story. You'll see subtle spikes on up days, indicating quiet buying by institutions. Distribution is the opposite. Near market tops, volume increases as institutions sell their shares to excited retail investors. The smart money is exiting. Part 11. The volume climax. This is one of the most dramatic signals in trading, a blow-off top or a selling climax. A blow-off top occurs after a long uptrend. Price goes parabolic on record-breaking volume. It signals exhaustion. The last buyers have entered, and a reversal is near. A selling climax is the mirror image. Extreme fear leads to massive selling. When volume spikes at the bottom, it often marks the point where smart money starts buying the panic. Part 12. Real-world case study. Let's walk through a historical trade example to see these principles in action. Notice this period of sideways movement. To most, it looked boring. But look at the volume. Consistent, above-average spikes on green days. This was institutional accumulation. Then came the breakout. A massive surge in volume confirmed the move. The smart money was finished accumulating and was now pushing price higher. As price trended higher, volume remained steady on the pullbacks. This confirmed that the big players were still holding their positions. This is how you follow the footprints. Part 13. On-balance volume. OBV is a cumulative indicator that relates volume to price change. It's one of the most powerful tools for spotting hidden trends. If the current close is higher than the previous close, the entire day's volume is added to the OBV. If it's lower, the volume is subtracted. This creates a running total of smart money flow. We look for divergence. If price is moving sideways but OBV is rising, it signals that smart money is quietly accumulating. This often precedes a massive breakout. When price and OBV rise together, the trend is healthy and confirmed. It's a signal that participation is growing alongside the price. Part 14. Volume profile. Standard volume shows activity by time. Volume profile shows activity by price. It tells you exactly where the most trading occurred. The value area is where 70% of the trading occurred. It represents the fair price as agreed upon by the market. Prices often gravitate toward this area. High volume nodes act like magnets. They are levels where the market found a lot of agreement. These areas often act as significant support or resistance. Low volume nodes are the opposite. They represent areas of rejection. Price often moves through these zones very quickly because there is little interest or liquidity to stop it. Part 15. Tick volume versus real volume. In centralized markets like stocks, we have real volume, the exact number of shares traded. In decentralized markets like Forex, we use tick volume. This measures the number of price changes. While not identical to share volume, it is a highly reliable proxy for participation. Studies show that tick volume and real volume are over 90% correlated. For most traders, tick volume provides all the participation data you need. Part 16. The psychology of a volume spike. A massive volume spike is a moment of total market participation. It's where the crowd is forced to act. This is where emotion is highest. High volume at a market bottom represents total capitulation. The moment the last sellers give up in fear, that's often when smart money steps in. Volume spikes represent a transfer of ownership, from the weak hands to the strong hands, or vice versa. It's the ultimate psychological turning point. Part 17. Volume spread analysis. VSA is the study of how volume, price spread, and the closing price interact to reveal professional intent. A no-demand bar shows a narrow spread on low volume. It tells us that professionals are not interested in higher prices. It's a classic sign of a coming reversal. Stopping volume appears as a massive volume spike on a down bar that closes well off its lows. It signals that professional buying is absorbing the selling pressure. The downtrend is over. Part 18. The volume breakout strategy. To trade this effectively, look for a period of low volume consolidation. The market is resting. When volume dries up during consolidation, it means there is little selling pressure. Then, watch for a price breakout accompanied by at least 2 times average volume. That is your entry signal. The high volume confirms that the big players are pushing the move. It significantly increases the probability that the breakout will hold. Part 19. Professional screen setup. Keep your volume bars at the bottom of your primary chart. Don't hide them behind other indicators. Color them to match the price candles. Green for up days, red for down. But remember, focus on the magnitude. The height of the bar tells the real story, regardless of the color. Part 20. The Master Summary. We've covered everything from basic participation to advanced VSA and volume profile. Volume is the heartbeat of the market. In a market filled with noise and manipulation, volume is the one thing that cannot be faked. It is the footprint of reality. Master it, and you master the market. Homework challenge. Open 5 stock charts today. Study one breakout with high volume and one with low volume. Analyze the difference in result. Find one significant volume spike. Look for one strong uptrend supported by increasing volume, and one weak trend with declining volume. Connection is key. Train your eyes to connect price and volume. This single skill can transform the way you analyze markets and help you follow the smart money. Today you learned why professional traders study volume. You learned how volume confirms trends, strengthens breakouts, and reveals institutional participation. Tomorrow we will study one of the most popular indicators in the world, the Relative Strength Index, or RSI. We'll learn to measure momentum. Subscribe to Wealth Entertainment 21. Turn on notifications so you never miss a lesson in this 30-day masterclass. Join the community. And remember, price tells the story. Volume reveals the conviction behind it. I'll see you in episode 10.